Hello YouTube! Welcome to Stocks Are Stocks. My goal here is to give you stock information and valuations in as concise a format as possible. Today we review Meta. We will cover the current share price movement, earnings, risks, opportunities, financials, and valuation. Meta is down 38% since it reported earnings and 48% over the last 6 months. The reason for this has been attributed to an EPS miss and a decline in Facebook daily active users. Today we are going to go through Meta's earnings and shed some light on whether this insane decline is warranted. First, I want to start by going through the shareholder slides Meta releases alongside its earnings report to address the decline in Facebook daily active users. This is the number the media has been harping on. However, I want to draw your attention to this footnote. The numbers for daily active users and monthly active users do not include users on Instagram, WhatsApp, or our other products unless they would otherwise qualify as daily active users or monthly active users respectively based on their other activities on Facebook. We can see that these numbers are only for Facebook. These numbers do not include WhatsApp or Instagram. I believe we all knew Facebook's numbers would plateau, and it was honestly insane that Facebook was still adding users. Who does not have Facebook at this point? I believe this plateau should have been expected, and quarter-over-quarter growth for Facebook has dramatically slowed. However, there is a more correct metric that is inclusive of all growth at Meta. This is found here in the shareholder letter slides. Family daily active people. This includes Facebook, Instagram, and WhatsApp, and we can see Meta is still growing. The media has not focused on the correct metric, and Meta has specifically noted in its disclosures that this should be investor focused moving forward given Facebook's mature age as a product and Meta's other business lines. Here in the previous quarterly SEC filing, we can see Meta started reporting this metric in 2019 and believes this metric better reflects the size of Meta, which I agree with. Meta actually lists this under limitations of data, which shows the media has focused on the wrong metric as Meta has specifically cited the limitations of this metric. Looking at Meta's loss on Reality Labs, Meta could have easily spent less on Reality Labs rollout to beat EPS. However, the sentiment you can garner from their earnings call is that Meta would like to paint a picture of being the underdog versus Google, Apple, and TikTok. I believe Meta decided to front-load the Reality Labs rollout to miss EPS and drive down the stock. Viewing this article by CNBC, we can see Meta is almost below the threshold Congress is using for new regulation is proposing. However, when we view the free cash flow, we can see Meta increased free cash flow by 36%. This is massive, and if we were doing a DCF valuation extrapolating from prior quarters, we would have a great 2021 year to start from. Meta may have slowing user growth, but Meta has found a way to grow average revenue per user very well. Furthermore, the absolute amount of ARPU is astounding. Meta still continues to grow average revenue per user at a good pace, growing it by 14% year over year this quarter. Reviewing the summary metrics Meta provided, we can see Meta is continuing to find ways to serve more ads at higher prices each year. Let's talk about Meta's main concern, Apple's privacy measures. I believe Meta has been able to navigate this well, with revenue growing 20%. I believe Meta is over-exaggerating the difficulty of building back its ad tracking capability to provide correct metrics for advertisers. Also, I believe the ability for the competitors to monetize better than Meta has been overblown. While revenue growth may continue to slow in the short term, Meta still has Reels, WhatsApp, and Reality Labs to monetize. As these products monetize, Meta's revenue growth will accelerate again. This is not the first time a large technology company's earnings has slowed. Google, Microsoft, and Apple have all experienced slowdowns in earnings, only to have growth reaccelerate. Microsoft experienced slow growth between 2012 and 2017 before reaccelerating. Apple has had a number of slow growth years shown here, before reaccelerating as well. And Google, while not having too many weak years, has shown trends of slowing down before reaccelerating. Reviewing these tech giants, one thing becomes clear: do not doubt big tech. While the Reality Labs loss for Meta is large, in the context of the overall business, an expenditure of $4 billion to build out Reality Labs is worthwhile. One of the most important things is owning your own platform. Apple owns iOS and macOS. Microsoft owns Windows, and Google owns Android. While the expenditure may seem large at first, if Meta is able to become a major platform with VR, not only in social media, but also as a competitor to Xbox, PlayStation, and Nintendo, it is a worthwhile investment to make. It is not unreasonable to foresee a time where Meta has over a 300 million user install base, given its huge user base of 3.59 billion users across its family of applications. I also believe Meta will be able to monetize its own platform better than it currently does on Google's Android. Meta's ARPU in the United States was $60. We can assume those able to afford a VR set sit in the higher income brackets of people in the world, similar to the US. So I will assume all of those who can afford a VR set can be monetized at that level. I would not be surprised if Meta is able to conservatively monetize VR at $150 per user down the line. However, given VR can tap into and track more of your senses and the myriad of additional monetization avenues, I believe the true monetization ability is far in excess of what Meta is currently able to do. To get an idea of the revenue this can add, using 300 million users and 150 revenue per user, we get to $45 billion of additional revenue. Accounting for some cannibalization, let's say 15 billion, this would be 30 billion in additional revenue, but with much higher profit margins. Going over the key financial metrics for Meta, we can see that the revenues for Meta have grown significantly year over year each year, and even the latest year still posted revenue growth of 37% year over year. Moving on to gross profits, we can still see that that is also moving in line with revenues, moving at 38% year over year. This is similar with the operating profit, moving at 43% year over year. Moving down to net income, we can see an increase in line with the revenue. The profit margin has remained steady over the last couple of years with little fluctuations. One of the most key metrics to watch is the free cash flow. The $39 billion generated this last year was a 66% year-over-year growth. Meta has continued to generate strong free cash flow growth. At the end of the year, the company traded at a 24 PE. Now that we have reviewed the financials, let's see what a valuation model tells us. Utilizing a 9% growth rate in earnings, a 12.5 discount rate, a terminal PE of 15, and a 10-year period, I find Meta's true valuation to be $206 per share. This is extremely conservative, but it still shows Meta to be a good value, with a 24% margin of safety. However, what if we wanted to be more conservative? Increasing the discount rate to 13.5%, it is still a good value at $249 per share. Moving away from doom and gloom, if things go remotely right for Meta, I have used a 13.5% growth rate and a 12.5% discount rate and a terminal PE of 17 over a 10-year period. With this, I derive a current value of about $400 per share. This provides significant upside. Meta's recent decline is overblown. While the revenue growth may decline now, Big Tech has proven it can re-accelerate revenue growth time and time again. I believe Meta is a good buy at these values given the significant upside. Please leave a like if this was helpful and a comment if it was not, or if you disagree with any of my points. Bye.